I am sick and tired of shady salesmen pitching whole life insurance as a good investment for real estate investors. So I'm going to expose their outrageous claims right now and explain the flaws with all their supposed benefits. I'll cover being your own bank, the tax benefits, legal protections, and whether it's better than retirement accounts as they like to claim. I'm rich on money. I'm not going to let you get ripped off. Let's get into it. There is a current fad of convincing real estate investors that purchasing a whole life insurance policy and then borrowing against it is the smartest method to grow your real estate portfolio quickly. It's sometimes called infinite banking. For infinite banking to work, you need a whole life insurance policy. These whole life policies stay in effect until death and have a cash value that grows as you contribute to the policy. This cash value can be borrowed against. In addition to the cash value that is growing, there is also a death benefit. Real estate investors like us could buy real estate with these loans. No need to bother applying to a bank, no credit checks, no docs to turn in. You're the bank. Sounds pretty cool, right? Well, let's take a closer look. A whole life policy has a cash value that is growing at about 4% per year, tax-free on average. Compared to other choices we could make, infinite banking is a poor choice for your money. Money invested in an IRA or 401k, invested in a S&P 500 index fund would be projected to make between 8 and 10% on average over a lifetime. It would also be tax-free or tax-advantaged. You may think that 4% versus 8% would mean that you could make twice as much in 401ks or IRAs as you could in whole life-based products like infinite banking, and you would be wrong. Remember, this money compounds over time. It ends up being not double, but several times more money with 401ks and IRAs than waiting for cash value to grow. The difference is multi-millions over a lifetime. Now, I can see the gurus and the whole life lovers' faces getting red as they watch this video. They're trying to figure out how to shut me up. And to them, I say, don't worry, no one watches my videos. You'll see various forms of this infinite banking strategy offered, often under different names or confusing acronyms. Some examples are Be Your Own Bank, IUL, MPI. They all claim to be better than each other, perfect for what you need, but they all are roughly the same thing. These infinite banking gurus all argue that by obtaining a whole life insurance product and then borrowing against it, you are becoming the bank yourself and outsmarting the evil and predatory banking industry. Certain whole life gurus will take the argument further, saying the government is suckering us into investing in IRAs and 401ks where they can tax us. In other words, some of these salesmen are trying to convince us that IRAs and 401ks are a scam and we should invest in their insurance product instead. Now I'll quickly talk through the main aspects of the infinite banking strategy that are often misrepresented and difficult to understand. The gurus will argue that the infinite banking strategy is a tool of the ultra rich and we are missing out big time by not using the same tool. They also argue that even banks buy whole life. Well, they're telling the truth. Banks and ultra rich people buy whole life insurance. But why? They buy it because it makes slightly more money than treasury bills and bonds. It's a safe form of diversification for the banks and ultra rich. They're happy getting 4% growth when treasury bills and bonds are paying less. But I can tell you the ultra rich did not become ultra rich because of 4% growth. They made the bulk of their money from their businesses, retirement accounts, brokerage accounts, and even real estate. Only after taking advantage of all of these and still having leftover money, they might put it in something as low yielding as a whole life policy. So it's safe, but it's not a good idea for the average person who needs to put all the income they can to work. There's a huge opportunity cost to committing to 4% growth, even if it's tax-free growth, over getting 8% through other methods like traditional index fund investing in 401ks and IRAs. Now let's talk about fees and commissions. Whole life insurance gets a really bad rap if you Google it. There are lots of people that feel like they've been taken by shady whole life salesmen. One reason is whole life insurance policies often have a large commission that can be 60 to 80% of 1 year's premiums. But I've been fighting with these infinite banking gurus long enough to know that commissions aren't that high if the policy is structured correctly to be borrowed against. If structured correctly, then commissions are reasonable. I'll give you that. But there are still fees to worry about. So do your best to read the fine print, and it's still pretty damn hard to figure out what portion of your premiums are fees and commissions. Now we need to talk about the break-even point for the cash value available to borrow against. The whole point of setting up infinite banking is so that you can be your own bank. Take out loans without having to ask permission. So does that really happen right away when you buy a whole life policy? No. You only get to borrow a portion of the policy premiums that you pay in. And this doesn't even start for a few years into paying premiums. In other words, there isn't a magic ability to start borrowing more money. You only get to borrow what you've paid in premiums minus commissions and fees. This will eventually be assisted by roughly 4% tax-free growth, but that's going to take years. And here's the kicker. It takes several years until the amount you've put in will match the amount you have in cash value to borrow against. Basically, that means there are several years early on of negative returns on the money until fees and commissions are paid and you've had enough growth just to break even. This is called the break-even point, and you want to find out how long that takes. 5 to 7 years is pretty standard. Now let's talk about surrendering a policy, which is essentially canceling it. An infinite banking product can be a large financial burden. It's pricey to undo. It's sort of like having a mortgage payment that you need to pay monthly for the rest of your life. You might have something happen in your life where it becomes a burden to pay that each month. Maybe a disability or a loss of employment. Can you just cancel your policy and take your cash value out? Well, if you cancel early on, you'll be penalized. There's something called a surrender fee, which is typically 10% of the cash value. Make sure you know how much it is and how long it lasts if you're seriously looking into this. This amount might go down incrementally as you hold the policy longer. Sometimes after 10 or 15 years, there is no longer a surrender fee for canceling. There are, however, tax consequences to be concerned about if you cancel. You may owe taxes on cash value over what you've contributed. Speaking of taxes, the tax benefits of these policies are another supposed benefit often touted by these gurus in slick suits and fancy cars. Let's look into this. You'll be told that the death benefit received is a tax-free benefit, and that's true, but that is not unique to whole life policies. Any life insurance policy is not subject to income tax for your heirs. You may be subject to estate taxes, however, so keep that in mind. The cash value grows tax-free, you'll be told. Well, again, this is true, but it is not impressive. If I have a choice between 4% tax-free growth or 8% tax-free growth in a 401k or IRA, I'm taking the 8%. But the loans are tax-free, the guru will tell you. Yes, that's true. But again, this is not a unique benefit of whole life policies. All loans of any kind are tax-free. Why? Because you still have to pay the loan back, and usually with money that's been taxed. Okay, so the tax benefits aren't that impressive. But whole life insurance is protected from creditors, says the sweaty salesman, and this is true in many but not all states. But this is not a unique benefit either. 401k plans and other qualified retirement accounts are protected from seizure by creditors. You could say these accounts even have better protection than whole life. Some gurus argue it's not an investment, but it's a tool. Well, whatever. Regardless of what you call it, you need to compare it to other options for your money, and it suffers badly by comparison. So here's my summary of this investment. Don't buy any type of investment or tool that involves whole life or some form of it with the ability to borrow against the cash value. It's an inferior investment to almost anything else you can do, especially traditional retirement accounts like 401ks, military or federal TSP, or IRAs. You'll come out way ahead with traditional retirement accounts with multi-millions more over a lifetime. Stay away from this crap. This is Rich Carey. Hope you like this video. If you want to kick ass with money, subscribe to this channel. Rich Carey signing off.